we were in negotiations.
Investing in real estate, they're winning, they're making money.
What's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you can build on. I am your host, Kevin Amolsch. With me today, co-host Mr. Justin Cooper. We're super excited about this episode, this quarterly market pulse. If you're just tuning in, hit like, hit subscribe. If you're checking us out on Spotify or Apple, do us a favor, please hit a 5-star review and share this with your friend. And Mr. Cooper, do we have a friend with us today?
We sure do. We've got the lovely and talented Mr. Joe Massey, someone we've known and trusted in our business for well over a decade now.
Yeah, well, Joe, welcome to the show, man. I'm excited to get into the market with you this quarter, Q1 2024.
Yeah, and I just want to thank both of you gentlemen for having me on. And of course, gentlemen is a term that I use very loosely, but I am really grateful for both of you guys inviting me onto your podcast. It's always nice to see you both. You're fantastic business partners, and just always excited to be able to share information and chat about the market with you guys.
Yeah, I'm excited to dig in here. So before we get too far into it, Mr. Massey, why don't you tell us a little bit about who you are and why we even want you on this podcast?
Sure, absolutely. Again, my name is Joe Massey with Castle & Cook Mortgage, and I'm a mortgage lender based here in Denver, Colorado. I've been in mortgage lending just past my 22nd year. So 22 years I've been in mortgage lending, and I focus on really the Denver metro area and pretty much all of Colorado, but focus on the Denver metro area and do a lot of work with investors. About 35% of our clients are real estate investors, some that own 1 property, some that own 10 properties, and really like to focus on market knowledge, what's happening in the rental real estate world, what's happening with the Denver market overall, and hopefully can have a couple of good ideas and be a good resource for you and your listeners.
Yeah, and I'm so grateful that you come on, because you are the expert when it comes to this stuff. And this is why we want you here, because you are in the trenches, right? You're out there in the field every single day working with real estate investors, and you sort of have your hand on the pulse. So you know what's going on. So maybe let's get started. I know yesterday, this isn't going to be released immediately. So by the time this is released, maybe it was last week, you did a webinar with some pals of yours talking about the economy and what's going on, some of the changes we're seeing in Denver. Maybe we just start there, man, because it's fresh in my mind. I just participated in it. So what did we learn quickly on the webinar?
Yeah, so the number one thing that's a concern that we're seeing in the Denver market is a lot of rental units coming online within the next 4 to 6 quarters. We had a great chart that showed there's going to be 20,000 plus rental units coming online within the next 18 months. And a lot of property investors are concerned about what is that going to do to rental rates. Number one, it's going to increase vacancy, right? Because a lot of those units are not going to be vacant, or excuse me, they're not going to be occupied when they come online. So you're going to see vacancy go up. It'll actually be a headline you'll see in the Denver Post, the Denver Business Journal, that vacancy will go up with a pretty big spike. But the point of that I like to share with our listeners is a lot of our mom and pop investors own A-, B, B-, C properties. Everything, or virtually everything that's coming online in the next 18 months are downtown condos, A+, A++ style properties. And those are not necessarily a competing product against a mom and pop investor that maybe owns a condo in Aurora or a single family home in Lakewood. So I think there's going to be some nervousness about vacancy increasing, but I don't necessarily know that it's going to impact our individual clients and some of your individual clients. But I'd love to hear your guys' thoughts on that topic.
What do you think?
Yeah, I think that was such a great point you just made about vacancy rates going up, because it's absolutely going to be a headline, right? Because it may jump up dramatically, like you were saying, but not understanding the rest of the story, not just what that headline is. The fact that vacancy went up is because we just had 10, 20,000 units come on the market, and it takes time for those to lease up. Such a great perspective there on that. And then, the style of units that these are going to be, again, that's really important to understand, because it doesn't compete with everything else on the market. So, fingers are crossed, although I don't know if it'll really come through in those stories underneath the headlines. But it's so important to understand not just the headlines, right? How many of us, I'm very guilty of this, of just scrolling through things on my phone, and catching these headlines. And now I got, some buzzy little topic to talk about, when I go out for drinks with some friends. But really understanding the nuts and bolts and the reasons why, I think, is so important. And I think that's honestly why we're doing this podcast, is to not just talk about the headlines, but to actually get into the nuts and bolts of the why we're seeing what we're seeing.
Yeah, and it's interesting because statistics can be twisted any way you want, really. So, and the only reason I say that is because I'm just want to share kind of what I think of when I hear these staggering numbers, Joe and Coop, and see what you think. Because for the most part, I agree with you. But two things. First, let me just get the inflation thing out. We're fighting inflation right now, and the Fed is winning this war, but we don't know, like, how well did they overcorrect? I mean, is there maybe more hikes coming because, the 6-month average on the PCE actually went up, which is concerning. So when you have this many Class A apartments coming in, that's going to be a higher monthly rent amount, right? So we might see some people moving that can afford it, some people moving from a Class B into the Class A because there's just so much to choose from and they find the perfect spot. So we could see maybe artificial rent increases in the inflation numbers, and we know that housing accounts for over a third of that inflation number.
That's
So
right.
do you think that this number of Class A units is going to push inflation up when we're trying to fight against that?
Boy, that's such a good question. I guess, can I give you maybe two answers? Number one, inflation is a nationwide statistic. What's happening here in Denver is just a very, very tiny drop in the bucket. So my initial answer is no. I don't think that the local units that we have coming online are going to make any impact on that. But I don't study other markets, and we might have other markets that have a lot of apartments coming online that could push that number up. So I think my direct answer is no, I don't think so, but maybe, depending on what's happening in all the other markets. And I want to stick to this because I know this is the topic at hand, but I have a couple of ideas about inflation and interest rates when we get to that. So don't let me forget to talk about
Let me get my other point out here.
Yeah.
And Coop, maybe you tell me what you think about this, because I agree with Joe for the most part. We're Class A, so it's not going to be competing with your and I's Class B single family home in the suburbs, right? But is there a point where there's so much supply of Class A that it brings the rents down to a level that it's competing with Class B, and then people start to jump at that point?
Yeah, that's what I was thinking. In regards to inflation, right? We're talking about prices going up, but why would prices go up, right? It's a supply and demand issue. And with that much supply suddenly flooding the market, are all of these apartment buildings going to be in cahoots and just lock in the super high prices, or are they going to get competitive to drop their vacancy rates faster than their competition? And they're going to be giving out a cheaper product. So it will certainly be interesting to see that. And I don't think we'll ever get an exactly right answer, because nobody's actually going to say what their strategy is behind their pricing. But it's going to be mixed. There's certainly going to be those people who want to move up to the nicer units. When I was living in an apartment downtown, and then an opportunity came up for me to move to a brand new apartment building for the same price, that made a lot of sense for me, right? So I upgraded the quality of the housing for the same price. But depending on what people, the mom and pop, as Joe keeps saying, a lot of us have single family units, right? And so we may have more bedrooms, we may have yards, even in our duplexes. There might be other amenities in our, townhomes. And this appeals more to families, right? Families who have pets, families who have kids, they want to run around in a yard. Whereas the Class A downtown apartments are just a very different product, and they don't really allow for those same types of things. So it'll be really interesting. I have a feeling it's more for the younger folks moving to Denver and moving to Colorado. That's who they're probably really trying to appeal to. But there's only so many of them, right? So how will it ripple through that? We'll just have to wait and see. But in the meantime, I have rents going up on some of my units, and I'm trying to do the best I can as I continue to supply housing more so for families in the metro area.
Yeah, Joe, what do you think? Because I want to clarify here. I do agree with you. I think it's a different class, And Coop's making the point where going from a house to an apartment and a different class, maybe that's too much of a stretch and we won't see too much movement between. But what are your thoughts after I said what I said?
I completely agree with what Justin said. I don't see that a family that's renting a single family for, let's make up a number, 2,500, and now there's a class A with a pool and a gym downtown for 2,500. I don't see that family is going to move into that style of home. Also, what you mentioned earlier, Kevin, is there going to be too much supply on these A-type properties that's going to bring prices down? Lon Welsh, one of our partners over at York Castle Real Estate, did a study of about 40 years of rental history and price appreciation in the Denver market. And what he found is very rarely do rents go down. Rents remain either flat or go up. But what may increase is rental concessions. For example, if you're driving by and you see a thing that says first month free, or $1 to move in, or get a free TV when you move in. So I do think rents will remain flat in those units, but I think concessions might go up and you might move in and get 1 or maybe even 2 free months. But the effect of looking at the graph of seeing rents go down, I don't think will happen.
I tend to agree that they do that with the new construction build to sell also.
Yeah. Yep.
Especially with the buy downs. Speaking of buy downs, maybe we talk about rates, but are you still seeing buy downs? What's a buy down and are you still seeing it?
Oh man. So buy down is generally a temporary buy down where you can get a lower interest rate in the first 1, 2, or even 3 years. And it's got to be paid for by the seller. It can't be paid for by the buyer. But you negotiate for the seller to pay a certain amount towards buying down your interest rate, towards paying some of your closing costs. So a real common one is a 2-1 buy down. So average interest rate as of today, when we're recording this, is 6.9%. So let's just pick on you, Kevin, say that you're buying a property. You've negotiated for the seller to pay 3% of the contract price towards your closing costs. Well, today's interest rate that you qualify for is 6.9. Using those concessions in the first year, your interest rate would be 4.9. In year number 2, your interest rate would be 5.9. In year number 3 and the remaining 27 years of the loan, your interest rate would be 6.9. So it's a way that you can use those seller concessions to minimize that monthly payment in the first 1 or 2 or even 3 year if you get a large enough seller concession. I just had a client who is closing tomorrow, and she was able to negotiate for the seller to pay 6% of the contract price towards her closing costs. So she's at a start rate of 3.9, 4.9, 5.9, and in year 4, she goes to that full interest rate of 6.9 with the hopes that interest rates will be lower at some point in the next 4 years, and she can refinance somewhere below that 6.9. So I see buy downs occurring on about 65, 70% of transactions right now. And I think it's a great strategy to mitigate some of the higher interest rate costs that we're seeing.
Yeah, that's interesting. I think that's unique to Denver. I don't know for sure, but some of the other markets we work in, we're not seeing those types of buy downs. On the new construction, for sure, all home builders are pretty much across the nation are doing that. But you're saying this is on existing product also.
Yeah, it could just be that I work with really high-end clientele that has great agents that are really good at negotiating.
Yeah,
I was gonna say not even a courtesy laugh.
It's gotta be that. What are you thinking right now, Coop?
Yeah, I've been hearing more and more about this, and I think it's fascinating hearing all these different, like, slightly more creative ways of selling homes, of approaching your financing. Kevin and I are hard money lenders, right? With Pine Financial Group. We're financing deals all the time, and we're talking to clients all day, every day. We're analyzing their deals. And something people always forget when they're analyzing, say, a fix and flip, is all the extra costs. They think, well, I'm going to buy it for this, I'm going to fix it for this, I'm going to sell it for that, and then I'm a millionaire, right? Because they see these HGTV shows, and that's all they show on the numbers they have on the screens, right? But the numbers that they're not talking about, and that are so often missed, is the closing costs when they're buying, the holding costs, and then the closing costs when they're selling, right? Mm-hmm. And so this is exactly what Joe was saying. In this case, if we're doing a fix and flip and now we're selling our fix and flip, we may want to incentivize those buyers to buy our property, right? And offering these buy downs could certainly be one of them. And so, typically, I'm saying worst case scenario, you may have 10% as the cost to sell, 6% for agents, 1% in miscellaneous title and recording fees, and then 3% in concessions. And for a long time, I would say that, but I wouldn't actually calculate it. I would run it at the 7%, 6% for agents, 1% for the title fees, because it was such a seller's market that the sellers didn't have to give those concessions. But now we're seeing those tides change a little bit, to where we really have to help our buyers out. And so, I think it's important that investors understand these things, that they're running the numbers, that they're changing and keeping their formulas fluid as the market and economy changes, so that they're better running their numbers. They have a better pro forma going in. They have a better idea of what profitability they should be expecting. And then, of course, if they need to change their purchase price, then they do that, because that, of course, is how we make our money, right? We do it when we buy, but we make our money when we buy, when we have good other numbers and good data, and we properly analyze our deals.
If I were selling a fix and flip right now, and I would love to hear your guys' opinion on this, I would include 3% seller concessions, and I would market that property with a 2-1 buy down, showing what that initial interest rate and initial payment is right out of the gates. I would build it into my pro forma, and I would offer it 100% of the time. And I would find a great lender to partner with who would help me market that property and make sure that that client really is approved for that loan. So I would love your guys' opinion, but I think it's a critical way that you can position the property for a fast sale in today's market.
Yeah, I'm not surprised you're saying that as a lender, but I
Of course.
100%, I 100% agree with you. Coop.
Yeah, I 100% agree. Because that's what separates us as investors from the general public. It's what separates the great investors from the good and mediocre investors, which is how much attention to detail are you putting into your properties. And it's not what color faucets, and the finishes and all the design and all that stuff. It's the listings. Are we paying attention to our listing agreement, or not necessarily our listing agreements, but to our listings and the remarks in there, and letting our potential buyers know all of the options, or what we're willing to give them, not just a beautiful house, but also help on their financing. I think it makes a ton of sense. And I think that's what the more savvy investors are doing.
Yeah, I want to talk about this a little bit, because I just pulled up the statistics from the Board of Realtors here in Colorado, and I'm just looking at Denver County here. And Coop, you made the comment where you're starting to see with your, I think you said, maybe you didn't say with your clients, but you're starting to see more concessions, and you would be budgeting in concessions. Joe said he would offer a concession on every deal he marketed. So obviously concessions is a relevant topic now, and maybe it wasn't a year ago. But listen to this and tell me if you guys think that this is, based on what I just said about concessions, tell me what you think about this. Days on market is up 2% from last year, 2023. This is January numbers. February hasn't come out yet. So January numbers was 48 days on market average in Denver, and now it's 49. So up 1 day. Now, inventory, 670 homes. Now we're at 587 homes. That's down over 12% from 1 year ago. That's an indication of a seller's market.
Big
And
time.
Joe, on this one, months of supply, which happens to be my favorite statistic to look at, because it looks at both supply and demand. We're looking for somewhere between 4 and 5 is what we would consider neutral. 2023, 1.3, it's up. 2024, 1.4 months of supply. So knowing that, those are all signs of strength. So Denver is strong. This is absolutely, the statistics tell me this is a seller's market.
I agree, but can I offer some anecdotal evidence that I see out there?
Please.
So I absolutely agree, but I would describe the market currently, and it's been this way for about a year, maybe 18 months, as a tale of two markets. What I mean is, if you have a property that's in a great location, that's listed at the right price, that has really strong marketing, that is a primo type property, we're seeing those get listed. And I just had one this past weekend. They had 15 offers. It was a $625,000 townhome in Highlands Ranch. They had 15 offers on it. And that property went under contract in 24 hours. Now, let's say you have not such a great property. We haven't done any repairs. We haven't kept up with it. We're listing it at the very top of the market, higher than all the other comparables, because we know it's a seller's market. And we just heard about our buddy that sold his property in 24 hours. And we're listing this over here, and it's not getting a ton of showings. All right. And what happens? That property sits for about 60, 75, maybe 90 days. Let's say that property sits for 90 days. This property goes under contract in 1 day. What's our average days on market? 45. What are we seeing in the market? 49. So there's not a ton of inventory, you're right, but I think it comes back to pricing that property appropriately and not having it over here at the outskirts at the high end of the price range with not a primo property. And if you do have something like this, that's where you're going to want to have concessions in order to get people off the fence after that property's been sitting for a while. So I don't see a lot of stuff trading at exactly 49 days. I see they're sitting for a while or they're going very rapidly. So I love those statistics because I think it really shows that tale of two markets, but that average is right in the middle at 49 days.
This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short-term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com. Now, Coop, what are you seeing with your clients?
Well, I think this all lends itself to having the right team in place. You know, if you have a good lender that you're working with, if you have a good real estate agent, part of what we're doing as investors is understanding our competition. So if we have that townhome in Highlands Ranch, then, you know, how many other townhomes in this development have sold? What else is going on? How fast did they sell for? Did they offer any concessions? You know, how pretty was it? You know, am I better looking? Am I worse? And really understanding all of these things. Of course, you know, we make a lot of these decisions and choices before we buy the property, but now 2, 3, 6 months down the road, the things have changed. You know, more properties have traded. So what's been going on with them, and really getting a deeper look, not just at the sales price and the square footage of the comparable properties, but what was really going on with those and how fast and did they sell, so that we can come up with the best pricing strategy. So maybe we want to price a little lower so that we can get 15 offers on day one. Maybe we want to go in at a fair price, but offer these incentives, or even maybe a tiny bit higher, but offering these incentives so that we'll still net the same amount. And the buyers will see the incentives and want to come out and make offers on our properties because they see all these other incentives. So I think something we all need to really be thinking about, and is the team we're surrounding ourselves with, right? Mm-hmm. We're hearing a lot about, you know, discount brokerages these days, and trying to get listings or listing agents to take 1%. I think we can all agree that you get what you pay for when it comes to listing agents. And so I've found it's definitely worth paying the full 3% to your agents, because they're going to work so much harder for you. They're going to put in that extra time and effort. And that's really, I think, who we want as investors in our corner fighting for us.
I agree.
Yeah, I was going to ask if you had anything to add, Joe. So here, I don't want to take up too much time, and I wanted to give our listeners the value, like what's going on in this market. What should we be looking for, looking at? And should we be buying? Should we be holding, hoard cash? Like what do you guys think?
I'll tell you my advice, which is what I'm doing. So it's not something I've made up. This is truly what I'm doing right now. Is I'm still actively looking for investment properties. I'm looking at properties that have been on the market for 60 days or greater, that are maybe listed 3 to 7% too high, but I can negotiate the price down a little bit, and I can negotiate some seller paid closing costs. I like to buy those, and right now you have to make a large down payment. If you want that property to cash flow, you've got to put down about 40% because of high interest rates and high fixed costs for taxes, insurance, and HOA. So for me, I still look for properties that are going to be a 5.5 to 6% cap rate, which, yes, I understand is like a needle in a haystack, but I'm patient and have plenty of time to look for the needles. So I look at properties that have been on the market for a while, that I'm comfortable putting, you know, a sizable down payment. It's not going to kill it on cash flow, but I feel really confident on appreciation in the coming years, and cash flow is going to improve as rents go up in the future. So that's my strategy, and I personally believe it is still a great time to find properties like that, Now, they're not out there all over the place, right? You have to spend some time looking for them, but that's my investment strategy, and that's what I see a decent number of my clients doing. I would also say some of my
Here in
clients
Denver. You're
are
only
yeah,
in Denver, right?
only in Denver. Yep. Yeah. But I would also say that some of my clients are sitting on the sidelines waiting for interest rates to go down because they can't cash flow without putting down a large down payment.
I'm so glad you said that. I want to hear what Coop has to say about this. And then I got a couple more statistics and a thought to throw out there.
Yeah, thanks, Kevin. I think, we just had our real estate investor success summit up in Minnesota very recently. And it's such a great chance to get to know and chat with a big group of investors all in one day. And so something I was hearing there and something I've been seeing with a lot of our clients here in Denver is the really successful investors are going deep. And so what I mean by that is they're not just saying, well, whatever works best for the deal, maybe I'll rent it or maybe I'll flip it, or some of these things that we can hear from newbies. If they're doing fix and flips, they're narrowing where they're looking for their deals. So they're farming a lot better. Farming better, meaning they're understanding their neighborhood. And instead of just looking across the entire metro or even just, in Denver, west of I-25 or something like that, they're really niching down the neighborhoods and they're getting extremely good at these neighborhoods so that they can make offers and then understand how to better negotiate on those properties, what the nuances of those neighborhoods are to find the diamonds in the rough in there. They're going deep with their contractors, getting better at managing their contractors, managing timelines. Because when it comes to fixing and flipping, time is of the essence, right? We want to move as fast as possible because when we're analyzing deals up front, all we're using is historical data. So if we take 9 months to do a fix and flip, we are now 9 months away from that historical data, maybe even more because the historical may have been 3 months prior to us getting that deal. So the faster you move on a fix and flip, the better. So having better contractors, having your listing agent ready to go, prepping all these things, having the stager ready. So as soon as that house is clean, you're staged, you're on the market, all these moving parts, stacking up all these little things means they're going to move faster and they're going to do better. Similar in the other way of rentals. The folks that are saying, well, I'll hold this for 1 year, maybe 3 years, worst case, I'll hold it for 5 years. I mean, those are, in my opinion, terrible timelines to hold rentals because one of the biggest benefits of owning rentals, in my opinion, is the appreciation. And so you want the longer timelines, you want the longer horizons. So, again, understanding what are your real goals? What are you really trying to get at there? Going deeper as to how can I maximize the cash flow in my rentals, in my neighborhood? What are the extra little perks I can do to increase that cash flow? Going deeper. I think that's what is really helping investors today. They're really, really dialing in what they're trying to do and how they're doing it.
This is fantastic. So what I'm thinking of is all of what you're saying is I love, but it's not really statistics. Like, what am I going to do right now? What should I do? Hold or buy? So in 30 seconds, Coop, what's your strategy? What are you doing?
Me personally, I still have the goal of being a landlord and accumulating more and more rental properties. That's what we're trying to do. And we're unwavering in that. Just because it may make more sense to do fix and flips doesn't mean my strategy is changing.
So what Joe was saying, he's looking for 6 cap on single families. So I just got to throw this out there. We don't need to necessarily have a conversation about it because I want to get into interest rates and the fight against inflation. But a 6 cap is a negative leverage property because you're borrowing at 8, right? So that means your cost of capital is costing you more than the property is returning to you. And it's by a 2% spread. So it's significant. Why that's important is the more money you put into the deal, some people would say that's less risk because you're not taking leverage, right? So if you actually pay cash for the house, no leverage at all, your cash on cash return is higher right now than maybe it was 2 years ago because of negative leverage. What Joe said, so we're looking on cash return, your 6 cap is going to be lower with a 40% down payment. Now, on the flip side, is now the time to buy. I keep hearing, no, I'm waiting for the crash. The crash is coming. The softening's coming. This is coming. And what we're seeing, and I should clarify this, these statistics that I'm spitting out here are single family only. I could go through the townhomes. I'm looking at it right now, but the single family, the single family new inventory hitting in Denver in 2023 was 373. Right now it's 458. So we're looking at a almost 23% increase in supply, in new listing supply. But I just said to you that the current active inventory is down. Right. So what does that tell us?
The properties are moving.
Properties
rapidly.
are moving.
They're moving very rapidly.
Yep. So that we are seeing an increase in demand, which is keeping that inventory low. So I don't know that we're going to see a big flux of inventory, which is why I'm always saying the best times to buy was maybe yesterday, and then the second one is today. I do think that you should still be buying properties right now. One more quick stat, and then a thought I had that I want to run by both of you. Median sales price. We typically look at median over average. It feels like it's a little bit more accurate of what's going on in the economy or the market, but median in Denver year over year, 8.4% increase.
Wow.
Again, this is single family. Let me see what the townhome is. Townhomes, condos lost. So I wonder what the blended is. Down 430 to 399,000. So single family, detached doing fantastic, attached not such a great year. It's interesting, but overall it's still up when you blend those together, right? So had you bought a house that you're waiting for the crash last year, you'd be up another 8%, right? So I would just caution the listener to try and time the market. What are your thoughts?
Oh man, I have probably a 20-minute diatribe that I could go into about why we're not going to have a foreclosure boom and why we're not going to have a crash, but I won't bore you guys with all of that. But there is a number of statistics that show this is not 2008. We are not going to have a real estate crash. We're just not. And I understand a lot of people think, well, interest rates are up, prices are up, something's got to give. The something is not going to be foreclosures. There is too many people with equity. Everybody that bought a home in the last 5 years has equity. Everyone's making their payments. Loans are performing better right now than at any point in history. Think about that for a minute. There is fewer delinquencies on a percentage basis than at any point in history. That is not an indicator of a coming foreclosure boom. So if you're waiting for the crash, I think you may be waiting a long time.
I actually have that statistic, that graph right here. So if you look at all loans, so this combines conventional, FHA, and VA. If you combine all three, the default rate right now, 3.88%. Okay. And I'm looking at this 4% line. Now it looks like it did drop below that, but only recently in 2022, it was below that. So we're not at necessarily historic, but if you look at the time period that we're in, it's still historic. And as far back as this graph goes, that number hadn't dropped below 4.
Right.
So what Joe's saying is absolutely right. And that's the leading indicator for foreclosures.
Yep.
Cool. Let's get into macro quick, and then we'll wrap this up. So you said you wanted to share something with us, Joe, about interest rates.
Oh man. So these are the thoughts that kept me out of the really good schools. But I was running the other day on the treadmill, thinking about inflation, thinking about, interest rates came down from 8% and down to like 6.6 about a month ago. Now, interest rates have started going back up. As of yesterday, average interest rate was 6.9%. That may be different when you're listening to this. And I was trying to figure out what's going on. There were so many predictions 90 days ago that the Federal Reserve is going to start decreasing interest rates. They're going to start decreasing short-term rates. We're going to have 3 cuts this year, 6 cuts this year. All of a sudden, inflation numbers come out, and inflation keeps going up, keeps going up, keeps going up. Well, what is the number one portion of inflation is housing. It makes up a third of that inflation number. And so the Federal Reserve is doing a great job. They have increased interest rates to try to bring inflation down. Well, that's a monetary policy, all right? But we have a systemic problem. Why are prices continuing to go up? Because we haven't built enough homes in the last 15 years since the Great Recession of 2008, 2009. So we have an inventory challenge. We're not building enough homes. Labor is expensive. Land is expensive. Water is expensive. Building a new home is very expensive. So it drives up prices because it's difficult to build new homes and the existing inventory is not enough for all the people that are moving to Colorado or in general moving to the United States, having babies. Households are expanding. So we have a systemic problem that is driving up inflation. We're trying to solve that with monetary policy of let's increase interest rates to slow down the market, and nobody can figure out why that's not slowing down inflation, because inflation is being caused by the lack of construction, the cost of construction, and the lack of resale homes. Again, I don't have any data to back that up other than a billion different slides I've looked at. But I think inflation may remain stubborn for a while, and it has nothing to do with monetary policy, is my opinion. It has to do with a systemic problem of we don't have enough houses and we have too many people.
You're funny. I don't have any data, but I have 1 billion slides exactly data, but none.
None that you can see. They're all up here. Like I said, these
So-
are the thoughts that kept me out of the really good schools.
To make sure the listener understands, so the CPI number, that's the one that has been bouncing around a bit. So that's the one that has gone up. PCE has actually been steadily coming down, other than what I said earlier in the call, the 6 month. But we don't look at it as 6 month, right? It's a year over year. So although if you look at a 6 month and you annualize it, that did pop up. But the inflation as a year over year number that the Fed looks at has actually been consistently coming down. But what I think is very interesting here, the PCE core, that's the one that they're looking at. That's when you hear 2% target, it's the PCE core number.
Mhm.
Okay. And I think we did this on the last call. So if you're confused on what the differences of our inflation are, go check that one out. But I just did an average of it, Joe and Coop. The PCE core average long-term, like 50-year average, 3.04%.
Mhm.
Right now it's at 2.8. As of last month, it just came out last week. So this is very fresh data. 2.8% is the PCE core number. It's lower than the long-term average. Why are we going after 2%?
That I don't know. It seems like just an arbitrary number that's been plucked out of the sky that we want to focus on. I don't know why that's the target number, actually.
I don't either. Coop?
Yeah, no, I think that actually is correct. I feel like someone did actually just pluck it out of thin air and said, this is what we need to shoot for. And when they started shooting for it, however many decades ago that was, things seemed like they were working in the economy. And so without a real good reason to change it, I could also be making this up, but I think that's actually what happened.
Yeah, I heard it was like Switzerland or something just came out. This is what I
New
learned on
Zealand
Saturday. Was it New Zealand? I can't remember. Some random country just came up with it and we adopted it. Is what he said. I have no idea. Did not fact check that. But I do find it interesting that inflation is actually under control if it's under the average. I would consider that under control. And
That's a
it's been
really
steadily
good point. I never thought about it over that historical average, and that is news to me. Even I'm learning something today, Kevin. That's
good.
That is a really interesting point, and I think you're spot on. It is under control if it's below the 50-year average.
Yeah, it's below the long-term average. I don't know if 50-year is the exact years, but it's what's considered a long-term average. Maybe it's 30, but it's whatever the long-term is. So it's definitely below that. We have wage inflation and income inflation over 4, which
Mhm.
is a sign of strength. When your wage inflation is over regular inflation, that means you're in a good economy. And unemployment well below the 5%, which is considered an active economy, right? It's at 3.7. So I mean, everything in macro looks like it's pretty solid.
Yeah.
Yeah. So I guess the question is, what's the Fed going to do?
We might not see the interest rate cuts that everybody's thinking, because that is, cutting short-term rates and then the trailing factor of long-term rates decreasing. That's a stimulating effect. And I think you're spot on. The numbers are pretty good. They might not feel a lot of pressure to cut anything. They might say, hey, we're just going to stay status quo. Short-term, long-term rates are going to remain pretty flat, not a lot of volatility. And that is different than my opinion 90 days ago. 90 days ago, I thought we were going to see a lot of cuts this year. As of right now, that prediction may have been wrong. I think we may remain relatively flat for the next 6 months.
Yeah, I kind of agree. What do you think, Coop?
I agree as well.
The
That's what you got
always
for us?
verbose.
All right. Well, I guess if there's anything else, we could wrap this up. But I think it sounds like the theme from this call, very similar to last quarter. Now is still a good time to buy. Interest rates are high, but you're not going to be, I hate the term, but you're not going to be married to it, right? You could refinance. And Joe, in fact, don't you offer a product where they do a refi at no cost or something? What's that about?
Yeah. So any client that closes with us currently, they receive a voucher at closing that says they can refinance at any point in the future with no closing costs. So, we've all seen that loan estimate that has your breakdown for processing, underwriting, title fees, etc. When you close on a transaction with us today or this year, you're going to receive that voucher. In the future, interest rates go down to 6%, 5%, 4%. Whenever you pick, you call me and you say, you know what, Joe, I want my free refinance. Your closing costs will be $0, and we'll get you whatever that prevailing interest rate is that you qualify for at the time. And so we've tried to take the risk out of it for the homeowner. If you buy a property today and interest rates go to 10%, congratulations, you bought at the right time. If you buy a property today and interest rates go to 4%, you don't have to pay to refinance. You call me and I'll give you refinance for free. Congratulations, you made a great decision. So in either scenario, buying today might make a lot of sense if it's the right time for your personal situation.
Yeah, love it. And I know we're out of time here, but I just got to throw this in here because I'm thinking about it. We have been getting a lot of calls, Joe, recently of people selling their Denver properties. They don't like the interest rates. They don't like the rents kind of softening, and they don't like all the regulations. So they're selling it and they're investing with us. You're not seeing that though.
Well, no, because people don't really call me when they're selling, right? So if our loans are
point.
paid off, I don't really know about it. But I will say I had a webinar yesterday with Eric Ross from EcoSpace Property Management, and that might be somebody that you guys might want to have on. There was 9 new regulatory changes or laws that came in through the state of Colorado starting as of January 1st, and they are very prohibitive to landlords. Certainly prohibitive to mom and pop landlords that don't have property managers. And to be clear, mom and pop, that's not a mean term. I'm a mom and pop landlord, but as opposed to like an institutional landlord. But some of those mom and pop landlords are having a tough time following some of these regulations. And Eric Ross is an absolute wealth of knowledge on that. I learned a ton on the webinar I was on with him yesterday talking about these new regulations, and it is becoming prohibitive to landlords, which I take a contrarian approach. I have a really good property manager. People are getting out of the rental market. Fantastic. I'd like to buy those properties, turn it over to Eric Ross because he's going to manage it and he's going to do a great job. So I see opportunity. Some people see headaches.
So the theme here is sell your rental properties to Joe, invest the proceeds with Pine, and then we're all 3 happy.
That's
I
a
love that
win-win-win.
No, I have a tremendous amount of respect for Eric. Jared in our office is a licensed attorney, and he's keeping up on all these regulations. So check out our YouTube channel because he's posting videos about what's going on in the Denver market right now. And I'm telling you, there is changes hitting landlords, and there's more that are proposed. So we're keeping a very close eye on this. So be sure to keep an eye on our channel. It's just YouTube/Pine Financial. Last words, Coop.
No, I agree with everything that we were saying. Now is still a good time to buy. And I love hanging out with you guys. I learn something every time I'm in the same room as you. So thank you so much for including me. And I can't wait till we do the next one.
All right, Joe, how do we get a hold of you, man?
My number's 303-809-7769. You can call me anytime. You can find my website, loansbyjoemassey.com. And Kevin, Justin, I just want to tell you both thank you. I always enjoy talking about this stuff. This could be a 6-hour episode as far as I'm concerned. I love talking about this stuff. Really enjoy spending time with both of you, and just grateful to be able to speak to your listeners. Thank you.
All right, man. Thank you again. And for you listeners, you viewers, please like, subscribe, 5-star review, and make this day a great one. Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.